Hey team, I hope you're well. And coming to you with the latest 6 slides on the Australian economy and the housing market. Hope that you find this insightful. As always, send through any questions or anything that you want us to cover next time. But thanks again to the research team for obviously all the analytics that goes into the view of the market that we have. First of all, interest rates. A lot of people are talking about the fact that interest rates are really high now. We thought it would be worthwhile providing some perspective because interest rates right now are lower than they were for most of my investment journey. And in fact, until around 2011, 2012, interest rates had spent about 30 years above the level that they are now. So we would say that the interest rate that the RBA has set has been normalising. It may have a little bit of a way to go, but it's getting very close to the top now. Interestingly, in the start of December, Philip Lowe was saying that interest rates were not on a preset path, and he removed that terminology at the start of February, which sent the market into a bit of a tears, thinking that that meant that interest rates were going to be a lot higher, and certainly the media jumped on it. Again, some perspective, he removed one sentence from the commentary. However, obviously, the CPI number that printed in December at 7.8 annualized, it's actually lower than what the RBA was forecasting in December. They thought that it would get to 8%. So the CPI number has come in below the RBA's forecast, which is actually a good news. And it's forecast to continue or start to reduce in the months ahead. And we'll be watching that really closer to see how that plays out, as will, I think, everyone else in the economy. Now, in terms of why did Philip Lowe might have changed his terminology? Well, if you look at the consumer sentiment chart that we showed, and this was for January, December, you can see that consumer sentiment started to improve once the Australian consumer felt that interest rates had kind of neared its peak in the tightening cycle. And perhaps that had a little bit to do with Philip Lowe's wording. So that sentiment is what the RBA is now trying to stamp out. And keep in mind that the RBA's influence on the economy actually comes from our sentiment as opposed to just the expenditure in the economy. And I'll touch on that in a moment. But you can see that after that change in wording and all the media that came out afterwards, that consumer sentiment dropped again in the start of February. So why would the RBA want to impact sentiment? Well, keep in mind that at least 30% of all Australian households own their home with no mortgage. Interest rates aren't going to do anything to affect them. Another 30% are investors, or essentially 30% of homeowners have a mortgage, and 30% of Australians are renters. So interest rates don't actually have any positive effect on rents. In fact, it has the opposite effect, because when mortgage payments go up, if there's a tight supply in the housing market, in the rental market, and landlords can put their rent up, they will put rent up to the maximum amount that they can to recoup their costs. So really, the RBA is wedged, and they're using interest rates as a blunt tool to try and impact consumer sentiment, because once consumer sentiment diminishes, people are more likely to stop spending money and to try and save money. So that's their biggest avenue for actually influencing the Australian economy. Keep in mind, the Reserve Bank's CPI basket doesn't actually include the cost of buying an established house. It's the cost of rent, it's the cost of building a new house, and then food, beverages, transport, energy costs, and so on. So a lot of the influence that they have is through this secondary transmission via sentiment. Now, something else that I thought would be worthwhile sharing is that sentiment rebounds really quickly. So in periods where sentiment drops below 100, you can see that it actually bounces up to be really favourable in the time that follows. And I guess this stands to reason that psychologically, you go through a period where your sentiment is diminished, all of a sudden you start to see a light at the end of the tunnel, And when you start to come out of the tunnel, everybody's super excited and thinking, well, that challenging time is now behind us. And we certainly saw that just after the GFC. We also saw it again just after the COVID lockdowns opened up, when Australians started to move around a lot more, and that sentiment really spiked. And we've talked about it before. Sentiment drives the housing market. I know that interest rates absolutely have an influence, but sentiment has the strongest influence. That's why we've seen markets like in the US leading up to the GFC, it was an oversupplied market that was absolutely booming because of sentiment. Even while interest rates were going up, that sentiment drove the market. And right now we've got an undersupplied market, but because sentiment has been a bit diminished, there's less activity in the housing market. Once that sentiment turns around, that growing undersupply is really going to start to drive the market. All right, so talking about undersupply, right now we have 30% fewer properties on the market than the 5-year average. So by all means, there's no way that you could argue that Australia's got an oversupplied market, or that prices are going to just fall through the floor, because we're actually seeing less properties being listed than they have been over the last 5 years. Keep in mind that the last 5 years also includes a 6-month period where there was almost no new listings because everyone was in a COVID lockdown. So a massively undersupplied market. We are seeing that the median days on the market are increasing. However, the 6-month moving average sales volume is still in line with our 5-year average. So keep in mind, we've got 30% less stock on the market, but the actual number of sales that are transacting are still in line with the 5-year average. So that means houses are actually turning over more as a percentage of what gets listed than would have been the case on average over the last 5 years. Yes, it's taking a bit longer to sell now than it did a year ago. But again, if you look at that chart on the bottom left, you can see that 34 days on market for a capital city is still in line with, actually below where it has sat prior to COVID. So again, it's a reasonably healthy market right now. And that's with very subdued sentiment that's impacting it still. So once that sentiment improves, we're going to see a huge shift in those market forces. And then when we talk about supply, we also need to talk about vacancy rates. The national vacancy rate's at 1%. The number of properties that are available to rent at any point in time right now is substantially below where it's sat for the last 10 years. So it's a massively undersupplied housing market, and I'll show you what that's doing to rents in a moment as well. Now, on the population side, so while we've got diminished supply, we're also starting to see a huge increase in in demand, which will be coming from population growth. So you can see to June 22, and this trend actually considered it towards the end of the 22 as well. You can see the huge increase in student visas being applied for. We've also seen a huge increase in short-term skilled migration visas coming through. And one of the things that I find really interesting, and when you look at the states of where the skilled migration is going to and by which country, you can see that, first of all, China's skilled migration visas are actually really low. That's because China had almost closed their borders until the end of 2022. So it wasn't until January that we started to see the reopening of China. And we're going to start to see more and more of, the people coming through, applying for visas, trying to relocate to Australia, as well as coming through on holidays. But when we look at the states, what jumps out at me is that WA has a disproportionate percentage of the actual skilled migration visas coming through. WA is about half the size of Queensland in terms of population, but they're only 10% less in terms of skilled migrant visas getting applied for in WA. And typically WA hasn't had the same proportion of skilled migration visas coming from overseas as some of the other states. So that's a really big tick there for WA as well. All right, now rising rents. So I touched on this earlier. We've got very, very low vacancy rates. And when you see the vacancy rate down at 1%, you know that it's going to take years to turn that around. And in order to turn that around, you actually need to bring on a lot more supply of new houses. And again, it takes a long time to get new houses out of the ground. So when you're seeing a period where interest rates are going up, that also diminishes construction of new houses, which actually exacerbates future supply imbalances. So this issue with rental market is going to get worse in terms of tenants going to have to be paying more rent in the years to come. It's the last 10% or the last year's growth is just the tip of the iceberg. So you can see that's trending up in pretty much of a straight line in terms of the asking rents. You can also see in terms of yields down in this bottom left corner that some cities are seeing much stronger yields than others. So while the national average for capital cities is about 3.6 and nationally for all houses 3.9%, which is getting back to pre-COVID levels, you can see in Perth, for instance, at a 4.8% rental yield. To put this in perspective, if you're borrowing at 5% and you're only borrowing 90% of the value or even 80% of the value of the house, then on an interest-only basis, then you should still be cash flow positive. That's not to say that you wouldn't be paying principal off, because the majority of borrowers do pay principal off their loans. But when you're paying principal off your loan, you're essentially putting money in the bank for yourself because it's creating equity. So you're moving money out of one bank account into another. So we don't see the principal repayment as any loss or an expense, because it's actually just shifting your asset from one account to another. But what we absolutely look at is that that cash flow on an interest-only basis. And again, it's looking very strong, and that's growing really quickly, keeping in mind that rents are going up 10% plus at the moment. Apologies for the terrible formatting there. The other thing that's worthwhile noting again is just this relative affordability. So when you compare 2023 to 2013, you can see that some cities, for instance, or some states, Victoria, Northern Territory, Western Australia, actually have better affordability in terms of the proportion of a household income that's committing to servicing a loan in today's dollars. So again, despite the fact house prices have gone up, wages have gone up a lot in the last 10 years as well. And so some states have got better affordability than they had 10 years ago. But when you look at the rent, again, this is a really clear and important thing to understand. When it costs more to rent than it costs to service interest on a loan, and when the likelihood of future rent increases is extremely high, then tenants become far more active at trying to get into the housing market. They can't all do that, but certainly with first home buyer incentives, that's going to help. So that's why we're seeing, I guess, stronger numbers of tenants trying to get into that first home buyer market, and it's going to continue, and that will snowball as rents go up more and more over the next couple of years. Now, coming back to sentiment, this came from CoreLogic just in the last week, and you can see here that while Sydney's median house price is changing and it's still slightly negative, it's almost back to 0%. And we're seeing that turning around in Brisbane, in Perth, and in the combined capitals. That's really important for, I guess, from the perspective of it affecting sentiment. So we know that when markets go into periods where there's less activity, fewer people listing their multi-million-dollar properties, the composition of sales shifts back towards the lower value sales. There's still a lot of turnover at the lower end of the market, where there are more active first home buyers trying to get in and trying to get out of the rental pool and into the housing market. So we know that happens, and statistically that brings down the median house price. And as the median house price comes down and the media latches onto that, they start running headlines about prices dropping, and that affects sentiment, which obviously then affects the number of people who actually list their property. So it means that median is likely to drop even further because the composition of sales continues to change. Eventually it gets down to a point of equilibrium where the number of sellers in that cohort of properties isn't changing from week to week. And once that happens, the median stops going down and it starts to stabilize. It's got no impact on prices at all. It's just the change in the data set that happens naturally through fewer properties being listed and transacting. Once that gets to 0%, then again, you look at a chart like this and the media starts to change their narrative and the people in the market go, oh, I might have actually missed the bottom because it looks like that happened in Sydney, for instance, in August 22. Again, it's just statistics. It's just the way that the numbers are created that it gives this impression. But these charts are absolutely used by the media. And what the change does when it improves sentiment, it starts to drive more people into the market who become active because they think, I don't want to miss out on my chance. And in doing so, they actually start to drive the prices up from the bottom again. So again, it's really important for us to understand that and to be able to articulate that to others, because we can see quite clearly here that there is a bit of a change in the way that these graphs are looking relative to the last few months. Okay, so to summarize this, as we know, there's a housing shortage and it's getting worse. The rental crisis is not going to be addressed in the next 6 or 12 months. We're seeing rents going up well over 10%. In fact, we know of some across our portfolio that went up 28% in 1 year. That's going to continue to grow. I can't imagine that it'll go up 28% 3 years in a running, because that would be the equivalent of doubling your rent in 3 years. But certainly there's a lot of increases happening there. Population growth and immigration is speeding up. So again, that's going to have an impact. The next set of numbers is not due until, I think, March. But yeah, absolutely, that's impacting the housing market and that rental scarcity as well. The RBA is trying to influence sentiment, and that's only going to exacerbate supply, because it'll mean that fewer people actually sign up to start a building contract. Those that do are going to reap the rewards, because when their house is finished, there's going to be an undersupply, and they'll be benefiting from it with much higher rents than they're seeing already today. The median house price is stabilizing, and as I noted, that's going to increase sentiment. And when sentiment improves, that's going to really start to drive volume and price increases from the bottom end of the market. The RBA has been a bit scared of that, as I noted earlier, and that's why they're trying to change the narrative a little bit to just perhaps over the next few months try to spook people a little bit to spend a little bit more cautiously on their consumer goods. But as we know, property is driven by sentiment, and that window to act where the sentiment has been dampened, that window to act is diminishing, because it's not far from when that sentiment starts to turn. And once it does, it'll be like a tide driving the market. So hopefully that all makes sense. Feel free to send through any questions that you've got. And yeah, thanks again to the acquisition and research teams for pulling this stuff together. Cheers.